The entertainment industry receives billions of dollars every year from governments around the world. Not loans or investments with expected returns or equity positions, disbursements, cash transfers from public treasuries to private corporations, governed by rules those corporations helped write, administered by officials those corporations helped elect, and justified by research those corporations commissioned and funded. The recipients of these disbursements include some of the most profitable companies in the history of the medium. They post record dividends. They acquire smaller competitors. They closed unionized facilities. They relocate entire productions the moment a more favorable jurisdiction presents itself. This video is about the mechanism by which that happens. It is not complicated. It operates in public, under official names, with documented paper trails. It has simply not been named quite clearly. That changes now. This program was made possible in part by contributions to your art economist from viewers like you. Thank you. Every year, governments around the world hand billions of dollars to some of the most profitable corporations on Earth. They closed unionized offices. They abandoned the countries that paid them the moment a better deal appears somewhere else. They do not apologize for this. They do not acknowledge it as a tension. It is simply the operating logic of the business. If you heard that description applied to the oil industry, you would recognize it as a problem. You would expect hearings. You would expect the phrase corporate welfare to appear in the coverage. You would expect at least one politician to call for accountability. If you heard it applied to pharmaceutical companies, you would expect a Department of Justice inquiry. If you heard it applied to Wall Street banks, you would expect it to be used as evidence in the next financial reform debate. This is not the oil industry. This is not pharmaceutical companies. This is not Wall Street banks. This is Hollywood. This is the games industry. This is the animation pipeline you grew up watching. This is the streaming platform you pay $13 a month to access. And you paid for it twice. Once at the subscription window and once at the tax window. The company received both payments. You received the content and the privilege of being grateful. The United States alone has transferred more than $25 billion to entertainment producers over the last 2 decades. 37 states are currently running active subsidy programs. The number grows every year because every state that tries to stop is immediately punished with lost productions and political pressure, and almost every state that tries to stop eventually gives in. This is a system. It has a structure. That structure has been deliberately obscured by the language used to describe it. Tax incentives, economic development tools, industry support mechanisms, language designed to make extraction sound like investment. This video will explain how the machine works, who built it, who benefits it, and why every serious attempt to dismantle it has failed. In January 2026, reporting from The Scotsman, TaxWatch UK, and several industry publications confirmed what the company's own public filings have quietly disposed. Rockstar North, the Edinburgh-based studio responsible for the Grand Theft Auto franchise, claimed £70.7 million in UK video game tax relief in a single fiscal year. In the same year, the company paid £85 million in dividends to its shareholders. Since the video game tax relief program was introduced in 2014, Rockstar North has claimed a cumulative total of £514 million. The last year the company lists taxation as a liability on its accounts, meaning the last year paid any corporation tax at all, was in 2015. Every year since, the British taxpayer has been a net contributor to the finances of one of the most profitable game studios in the history of the medium. Rockstar North is not a struggling independent developer. It is a subsidiary of Take-Two Interactive, a publicly traded American company headquartered in New York City. Take-Two reported revenues of $5.3 billion in fiscal year 2024. The Edinburgh studio produced Grand Theft Auto V, a game that has sold over 200 million copies and generated more than $8 billion in revenue. The studio produced Grand Theft Auto Online, a live service that has generated hundreds of millions of dollars annually for over a decade. This is the company that the British public has been subsidizing at the rate of tens of millions of pounds per year. The IWGB, the Independent Workers' Union of Great Britain, noted that in its coverage of Rockstar North that the studio's dominance of the video game tax relief allocation creates a structural problem for the program as designed. The relief was introduced to support the domestic game industry broadly. When a single studio claims a disproportionate share of the available relief, smaller studios that genuinely depend on that program to remain viable are crowded out. The program, designed to support British video game development, is functioning primarily as a profit enhancement mechanism for an American multinational. One additional detail completes the picture. While collecting public subsidy at this scale, Rockstar North terminated over 30 members of staff. The manner of those terminations was, according to IWGB, the most ruthless act of union busting in the history of the UK games industry. 70.7 million in public money in, 85 million in dividends out. 30 workers terminated and 0 corporation tax paid. This is what a successful use of the incentive looks like, according to every official who has defended the program. Between 2020 and 2024, Ubisoft received approximately 980 million Canadian dollars in tax credits from federal and provincial Canadian governments. That figure, $980 million, represents more public subsidy than Ubisoft received from every country it operates in combined. More than France, where Ubisoft was founded and where it's still headquartered, more than the United Kingdom or the United States, more than any other single country on Earth. Canada was, in this period, the single most generous public funder of Ubisoft's global operations. In December 25, 61 of the 71 workers at Ubisoft's Halifax studio voted to unionize. It was the first Ubisoft union in North America. The workers had organized over concerns about job security, working conditions, and the stability of their employment. Reasonable concerns, as it turned out. 3 weeks later, Ubisoft announced that the Halifax studio would be closing. All 71 workers were laid off. The company cited cost efficiency as the rationale. The timing, 3 weeks between a union certification vote and a studio closure announcement, was not subtle at all. Labor law experts commented publicly that the proximity of the two events was legally notable. The Communication Workers of America described it as a retaliation. Ubisoft denied the characterization. In April 2026, the workers reached a settlement with Ubisoft. The terms of the settlement were confidential. Ubisoft kept the $980 million. There is a version of this story applied to a different industry that reads as a straightforward corporate maleficence narrative. A company accepts nearly $1 billion from a government. It uses that money to build operations in that country. When workers at one of those operations attempt to exercise their legal right to collective representation, the company closes the facility 3 weeks later and calls it an efficiency measure. In this version, the pharmaceutical, the financial version, the manufacturing version, there are investigations, clawback provisions, legislative hearings, sustained political pressure. In this version, the company issued a press release, the studio closed, and the subsidy remained unreturned. The Canadian government has not announced any review of its subsidy arrangements with Ubisoft. The credits have not been clawed back. The program through which they were dispersed remains active. Amazon's adaptation of the appendices of Tolkien's Lord of the Rings represents, in some ways, the purest expression of the nomadic subsidy model, the practice of structuring productions to maximize public subsidy collection across multiple jurisdictions simultaneously. Season 1 was produced in New Zealand. The New Zealand government provided approximately $100 million in tax incentives. Amazon representatives stated publicly during pre-production that the project represented a long-term commitment to the country and would contribute to lasting infrastructure development in local film history. The production hired extensively from local crews. The New Zealand film industry treated it as a major and durable economic relationship. Amazon began production on Season 2 in the United Kingdom. The decision was not primarily creative. The showrunners, when asked about the relocation, stated publicly that this was above their pay grade. That is an accurate description. The creative team did not make this decision. The financial team made this decision. They made it by conducting a comparative analysis of available tax incentive structures across eligible jurisdictions and determining that the United Kingdom offered superior economics for the production-specific budget profile. The UK tax incentives dramatically reduced production costs from the first season's $465 million budget. The documented UK rebate for Season 2 was £72.8 million. Additionally, significant portions of Season 2 were filmed in the Canary Islands, where a 50% Spanish tax rebate was available, allowing the production to run 4 units simultaneously across 3 jurisdictions, each collecting its own local subsidy. New Zealand received 1 season of production activity, $100 million in public expenditure, and a production departure that local crews described as abrupt. Crew members reported receiving 20 minutes of notice before the public announcement that Season 2 would not be filmed in the country. The show was not moved because it needed to be made somewhere else. There is no creative or logistical reason a Tolkien adaptation cannot be produced in New Zealand across multiple seasons. The show was moved because the math changed, because the United Kingdom offered more money, because the subsidy competition produced a better offer from a different jurisdiction. The subsidy was the product, and the show was the paperwork filed to collect it. Quebec is the controlled experiment. It is a case study that most clearly demonstrates what happens when a government attempts to reduce its subsidy commitments to the entertainment industry, and what that demonstrates about the nature of the relationship between the industry and the governments that fund it. The province built its games and visual effects industry over 2 decades through the Quebec Multimedia Tax Credit, introduced in the 1990s as part of a broader strategy to develop a domestic technology and creative sector. The strategy worked. Ubisoft established its Montreal studio in 1997, citing the credit as the primary factor in its location destination. Electronic Arts followed. Warner Bros. Games followed. Behavior Interactive grew into one of the largest independent game developers in the world. By the 2010s, Montreal was widely recognized as one of the most significant game development hubs on Earth. The province had, in other words, successfully used public subsidy to build an industry. The next question was whether it could maintain that industry without the subsidy, or at least with a reduced one. That answer came in 2014. In this year, the Quebec government proposed a $20 million reduction to the multimedia tax credit. The rationale was straightforward. The industry had matured, the infrastructure was established, and a modest reduction to the subsidy was fiscally responsible. Ubisoft responded by threatening to relocate operations out of the province. The government of Quebec backed down and maintained the credit at its existing level. A sovereign government operating with a democratic mandate and a legitimate fiscal rationale proposed a $20 million reduction to a subsidy for a profitable multinational corporation. The corporation said no. The government accepted that answer, and the credit remained changed. A decade later, in 2024, the province tried again. This time, the approach was a cap rather than a reduction, specifically capping the visual effects and animation credit at 65%. The response from the industry was immediate. Studio representatives told government officials that Quebec was no longer competitive when clients ran the tax credit calculations. Contracts were lost within weeks of the announcement. Studio began laying off staff. Digital Dimensions, one of Montreal's prominent visual effects studios, closed entirely. The province reversed course again. The numbers that surround this story are instructive about what the subsidy is actually purchasing. Quebec's subsidy on the multimedia credit rose from $298 million in 2019 to $488 million in 2024, an increase of more than 60% in 5 years. The credit now exceeds what the province spends on film and television credits combined. It is the single largest corporate tax incentive in the provincial budget. In that same period, record subsidy spending year after year, Montreal studios eliminated nearly 500 positions. The subsidy grew by 60%, and yet the workforce shrank. The money is not purchasing stability or jobs. It is not purchasing a domestic industry that will survive on its own terms. It is purchasing presence. The conditional, revocable, leverage-dependent presence of corporations that have made clear twice that they will leave if a check is reduced. Quebec did not build a games industry, it built a hostage situation, and every government in the world has pursued the model that has built the same thing. The question of whether entertainment tax incentives produce a positive return on public investment is not academically contested. It has been studied extensively across multiple methodologies by researchers at multiple institutions, and the findings are consistent. 23 states have conducted independent evaluations of their film and television incentive programs. 23 concluded that the programs are strongly revenue negative. Not a majority or most of them, every single one of the 23 programs, or independent evaluations, concluded that these programs were strongly revenue negative. The specific figures vary by jurisdiction, but the direction of the finding does not. Return estimates range from 10 cents on the dollar to approximately 30 cents on the dollar. No independent study of any state entertainment incentive program has ever found a positive return. Economist J.C. Bradbury at Kennesaw State University conducted a comprehensive survey of entertainment incentive programs across the country. His study found an average return of 27 cents per dollar of public expenditure. meaning that for every dollar transferred from the public treasury to production companies, the state recovered approximately 27 cents in total economic activity, including taxes, wages, and ancillary spending. The remaining 73 cents was a net transfer from the public to the industry. New York commissioned a 360-page independent valuation of its Empire State Film Production Credit, one of the most generous programs in the country. The study, conducted by PFM Group, found that the state received 31 cents in total direct and indirect tax revenue for every dollar dispersed to production companies. The study was a public document. It was available to legislators, journalists, and the public. The governor subsequently proposed adding $2.6 billion to the program over the following decade. The study was not cited in the proposal. Maryland's own Legislative Services Department evaluated the state's film production tax credit and found a return of 10 cents per dollar. The report concluded that the state was measurably worse off in later years than it would have been if the film tax credit had not been introduced. That is, the program had not merely failed to produce a positive return, it had produced a negative one relative to the baseline scenario of not having the program at all. Maryland renewed the program. Professor Michael Tom at the University of Southern California has published 4 peer-reviewed studies on entertainment tax incentives spanning nearly a decade. His findings are consistent across all 4. No negligible employment effects, no measurable gain in market share for domestic production, and no evidence that the programs produced the economic activity to justify them. In 2025, Professor Thom submitted direct testimony to the California State Senate Committee reviewing the proposed expansion of the California Film and Television Tax Credit. He stated that in that testimony that every independent evaluation conducted by any of the 23 states that had conducted one reached the same conclusion. The programs are strongly revenue negative. He presented this finding not as a critique of any particular state's program, but as the aggregate empirical record. California responded to this testimony by advancing a proposal to raise the annual credit cap from $330 million to $750 million, the largest expansion in the program's history. The research is not in dispute, the conclusions are not ambiguous, the governments know, and the programs expand regardless. The gap between the academic record and the policy response requires an explanation. The explanation is not that governments are unaware of the research, the studies are public documents. They are commissioned by the governments themselves. The officials who vote to expand these programs have access to the same numbers as everyone else. The explanation is capture. The entertainment industry has systemically embedded itself in the political and research infrastructure that governs its own regulation to the point where the mechanisms of accountability produce outputs favorable to the industry regardless of what the underlying data shows. The study most frequently cited by California legislators to justify the proposed expansion of the state film credit was not commissioned by the state. It was commissioned by the Motion Picture Association. The Motion Picture Association represents the major Hollywood studios. It is a lobbying organization. The Motion Picture Association and its member companies have contributed $168,000 to California legislators since 2015. The legislators who receive those contributions vote on legislation affecting those member companies. The research used to justify those votes was paid for by those same companies. This is not a conspiracy theory, ladies and gentlemen. This is a documented, publicly available set of financial relationships that anyone with access to California's campaign finance disclosures can verify. The industry funds the research that justifies the subsidy that funds the industry. The loop is intentionally closed. New York's 360-page commission study found that the Empire State Film Production Credit returned 31 cents per dollar. This was not a partisan document. It was not produced by an advocacy organization. It was produced by an independent financial consulting firm at the state's request using the state's own data. The governor reviewed this study. The governor's office reviewed its findings. The governor subsequently proposed adding $2.6 billion to the program. The study is currently available on the state government's official website. No official was held accountable for the discrepancy between the study's findings and the policy response. No journalist covered the contradiction as a major story. No legislator cited the study in opposition to the expansion. The study exists and the expansion happened, and these two facts coexist without tension in the public record. In the same budget cycle in which Governor Newsom proposed cutting healthcare funding and reducing allocations to the University of California system to address a $12 billion deficit, his office proposed doubling the annual cap on the film and television tax credit from $330 million to $750 million. The press release describes this proposal using the phrase economic recovery. The journalists who covered the budget cuts and the journalists who covered the film credit expansion were, in several cases, writing for the same outlets. The two stories were rarely placed in direct proximity to each other. In the first quarter of 2025, NBC Universal collected $21 million in New York State film credits for Saturday Night Live. The production employs, by the state's own accounting methodology, approximately 247 full-time equivalent workers. That amounts to $85,000 per full-time job in a single quarter, $340,000 per job annualized. Saturday Night Live is not a struggling independent production. It is owned by Comcast, a corporation with annual revenues exceeding $120 billion and a market capitalization measured in the hundreds of billions. It has been produced in New York for 50 years. It was not at risk of relocating to a different state. The credit did not create the production, it enriched the production's owner at public expense. This was reported, where it was reported at all, as a quirky data point rather than evidence of an economic policy failure. The word absurd did not appear in the coverage. The purpose of this section is not rhetorical, it is analytical. The question of why the entertainment industry receives treatment that would be politically unthinkable in any other sector is a substantive question on how public policy is made and what factors determine the threshold at which extraction becomes scandalous. Considering the following scenarios, substituting the actual facts of the case we have examined into different industry contexts. An oil company operating in the United Kingdom claims £70 million in government relief in the single fiscal year. In that same year, the company pays £85 million in dividends to its shareholders at its American parent company. The company pays zero corporation tax. It has paid zero corporation tax for 10 consecutive years. During this period, it terminates 30 workers in circumstances a major union describes as the most ruthless act of union busting in the history of the UK energy sector. In this scenario, there are parliamentary hearings. The Chancellor of the Exchequer is questioned. A windfall profits levy is proposed within weeks. The story runs in the front pages of the broadsheets. The company's CEO is summoned to give testimony. The phrase corporate welfare appears in coverage from both the left and the right. In the actual scenario, featuring a game studio rather than an oil company, the story ran in The Scotsman and several industry publications. No parliamentary hearings have been announced. The program continues. A pharmaceutical company operating in Canada accepts $980 million in public subsidy from Canadian federal and provincial governments over a 5-year period. It uses that money to build facilities and employ workers across multiple Canadian cities. When workers at one of those facilities exercise their legal right to collective vote bargaining and vote to unionize, the company's first union in North America, the company announces the closure of that facility 3 weeks later, citing cost efficiency. In this scenario, the Department of Justice opens an investigation on whether the closure constitutes illegal retaliation against protected labor activity. The story runs on the front pages of national newspapers. A Senate committee holds hearings. Multiple legislators propose clawback legislation requiring the company to return public subsidies if it closed facilities within a specified period following a union certification vote. The company faces sustained public pressure. Its executives are asked about it at every subsequent earnings call. In the actual scenario, featuring a game developer rather than a pharmaceutical company, a confidential settlement was reached. The subsidy was not clawed back. The program was not reviewed. The executives were not asked about it at subsequent earnings calls because the entertainment press does not ask those questions. A technology company is building a major infrastructure project that will operate across multiple countries. Rather than selecting a single location for the project, it negotiates with 3 jurisdictions simultaneously, accepting public subsidies and infrastructure commitments from each, then selects the combination of locations that maximizes its total subsidy collection. When it decides to move significant operations from one jurisdiction to another mid-project, the workers in the departing jurisdiction are notified 20 minutes before the public announcement. In this scenario, the Senate Judiciary Committee holds hearings on the use of public subsidy competition as a negotiating tool. Antitrust scholars testify about whether the practice constitutes an abuse of market power relative to smaller governments competing for private investment. The story is covered extensively by financial journalists over a case study in corporate leverage over public institutions. A documentary is produced and published on Netflix about it within 3 years. In the actual scenario, featuring a streaming service rather than a technology company, the showrunners noted that it was above their pay grade, the crew received 20 minutes of notice, and the story was covered primarily as an entertainment industry logistics item. A financial services program operated by multiple state governments returns 27 cents per dollar of public expenditure, according to every independent study conducted of any instance of the program. 23 states commissioned independent evaluations. 23 studies confirm the same finding. The programs are strongly revenue negative. No positive return has ever been documented. One state commissions a 360-page study confirming the finding and then adds $2.6 billion to the program. In this scenario, the New York Times publishes an investigative series on regulatory capture and state financial policy. The paper identifies specific relationships between the companies benefiting from these programs and the officials who expended them despite contrary evidence. This story generates sustained coverage. At least one official faces electoral consequences. The phrase, "follow the money," appears in multiple headlines. In the actual scenario, featuring film credits rather than financial services products, the expansion was reported as an economic development story. The contrary research was not cited in the coverage. No official has faced electoral consequences for voting to expand a program documented to return 27 cents per dollar. The protection the entertainment industry enjoys is not legal. There is no statute exempting film studios from accountability standards applied to other industries. There is no regulatory framework providing special treatment. The protection is cultural and it operates through two mechanisms. The first mechanism is the conflation of the industry with its products. The entertainment industry produces things people enjoy and identify with: film, game, television, music. The public's relationship with these products is emotional and often deeply personal. When the industry is threatened with accountability, it deploys that emotional relationship as a shield. Scrutinizing Disney's tax practices is framed implicitly or explicitly as an attack on the things that Disney makes. This framing is dishonest, but it is effective. The second mechanism is what this channel has previously described as the passion tax. The entertainment industry has cultivated a cultural narrative in which working in films, games, or television is understood as a privilege rather than a job. Something people do because they love rather than something they do because they need an income. This narrative suppresses wages by making workers feel that demanding fair compensation is ungrateful. It suppresses scrutiny by making the public feel that demanding fair policy is Philistine. You don't ask how much Disney paid in taxes, you ask whether the movie was good. This passion tax does not only affect workers, it affects governments, it affects voters, it affects journalists, it affects the entire frame in which the industry's behavior is evaluated. And it has allowed the extraction of $25 billion from American public treasuries over 20 years with essentially no sustained public accountability. You don't feel robbed when Disney takes your tax dollars. You feel grateful that the movie got made. That is not an accident. It is not a byproduct of the industry's cultural significance. It is the mechanism by which an industry that has never once demonstrated a positive return on public investment has continued to receive that investment for 30 years, across 37 states, across dozens of countries, in the face of a research record that could not be clearer. The research says 27 cents. The governments write checks for hundreds of millions. The studios collect the money, pay dividends to shareholders, close unionized facilities, relocate productions to better offers, and do it again the following year in a different jurisdiction. The public does not object because the public does not know, because the framing has been managed carefully enough, for long enough, that the question, how much did this studio take from my state's public budget, feels like the wrong kind of question to ask about an industry that makes things you love. It is not the wrong kind of question, it is the only kind of question that matters. You are an involuntary investor in this industry. You have never received a return, and the company has never once asked your permission.